Now, all shipping stocks are not created equal. Of course, some haul dry bulk cargoes, such as iron ore. Others focus on crude oil and other liquid products. So let's find out, how's business? Let's bring in an expert. We've got Urs Dur. He is an analyst at Lazard Capital Markets. He follows the shipping world. Urs, good to have you with us. Thanks for coming in.
Thanks for having me.
Smooth sailing right now for the shipping industry, or are we still stuck? Are we, that old saying, are we waiting for some kind of wind to get into the sails? What's going on?
Yeah, I mean, for dry bulk, in the broad sense, demand is much better than it was in the beginning of the year, and earnings are above net income break-evens per ship per day. So it's much better than where it was. On the tanker side, it's as bad as it has probably ever been in terms of the earnings per ship per day. Demand is low, but there are a lot of ships being delivered. So we have a split there. On containers, it's really coming up off the bottom. Volumes are getting better and better. So in a broad sense, dry bulk is doing the best. Containers are coming up off the bottom, but very, very slowly from a deep hole. And tankers are in a spot of trouble right now.
When you talk about this relative performance, you're benchmarking it against what was going on the beginning of the year, the end of last year. I mean,
sure.
That was a disaster, right? So, I mean, can you just give us, is there any sign that this is really a pickup in global trade, or are we just kind of bouncing along the bottom waiting for something else to happen?
But Chinese demand for dry bulk goods has been a torrid pace this year, and it's real. They're spending money on stimulus to make it happen. They have shovel-ready deals to do and projects to do, but also they are buying commodities as a hedge on a weakening dollar, which they foresee going forward, but both of which are real and push dry bulk demand. But dry bulk demand right now, to move it against what the ships are earning, the ships are earning basically two-thirds of what they've earned on average since 2001. So still lower, but a lot better than where we were. And again, it's money-making rates, so they're in good shape there.
All right, so let's talk about some of these money-making dry bulk companies and what are the stocks that you like. Let's start with Diana, for example. You like the stock?
Yeah, I like the stock. The company did issue equity earlier this year at a higher level, and the stock has since come down. But they have zero net debt to cap, $200 million in cash. They're going to buy ships in the next 6 to 8 months, I do believe, and they could bring back the dividend by this time next year. They're very healthy, and they're going to grow, so I like them a lot. I also like Navios, also very low leverage, and so they can buy assets which have come down in value now, buy low, sell high. Also, Genco is going to do some deals. So those are my three buys right now. Genco is ticker GNK.
When you look at the space, I mean, do you go right to the balance sheet and check out how much cash they have and how much debt either they have or don't have and how much is coming due? Because that seems to be part of the criteria.
Well, I think in certain markets you would love to have higher leverage, so if the market is really going to peak, then you have somebody who's going to get the most return. In this case, you don't want high leverage. The high leverage would indicate that you bought assets at a high level and they've since collapsed. You want to have a lot of dry powder to grow and lever up right now, and by doing so, well, by buying ships, you're going to be able to take advantage of the next cycle up. So less levered balance sheets are much more attractive right now. So lower debt levels, to me, are very attractive in shipping right now.
What about charter rates? I mean, if we take a look at sort of how much has been chartered out, what kind of contract longevity we're talking about? Let's say to start with Genco. I mean, they got their charters in place already for the rest of the year and for next year?
Genco is a majority of the remainder of the year covered, but they are exposed to a spot market that has been better so far for the remainder of this year, not so far, but better than the year has been so far. So they are, looking to have a little bit of upside. Diana is fully covered for this year. Next year is 65% covered, and Navios fully covered for what they own, and some more to exposure for next year, but still in very good shape. So in general, you have earnings visibility with all three.
Okay. All right, good. Yeah. We're going to continue the conversation. We've got more with Urs Dur of Lazard Capital. We're going to talk about container vessels as well as oil tankers. We're going to find out who is the best positioned to avoid the worst of any slump that exists in the marketplace. This is Taking Stock on Bloomberg. This is Taking Stock on Bloomberg. I'm Pim Fox. I'm speaking with Urs Dur, expert in the world of shipping, analyst at Lazard Capital Markets. Urs, before we conclude talking about bulk shippers, got to ask you about one of the names that everybody in this space wants to always know about. This is dry ships. What's going on with dry ships? You got a hold rating right now.
I have a hold rating. They get tremendous volume. Everyone does look at it. Has a great retail following and great as in being large. Can be extremely volatile. They have gone from being predominantly spot exposed to the dry bulk market to now almost fully covered by charters. They've refinanced and basically restructured the balance sheet of the company over the course of this year by issuing equity. And so I think investors are still a bit gun shy, plus they're fully valued against what they're going to earn for next year. Where dry ships is interesting is they have an ultra-deepwater drill rig business, two of which are on long-term charters, and then four...
They went out and they bought this business, right?
Yeah, they went out and bought the business, a very attractive business, and they have four on order, also for delivery in 2011. Those contracts are going to be very high margin. I do believe they'll be able to get contracts. They will have to raise finance. This is something that's going to take place really over the next 12 to 24 months in development, as well as I expect them to spin it off, the drill rig business. And that rig business has value, but until we see a better outlook for their baseline earnings, and until investors get over going from 40 million shares to 200 approximately 60 million shares today over the course of the year, so they're gun shy. I think that it's a hold on at this point in time, but the value is creeping up. So I do like the drill rig business in the future.
All right, so you'll let us know when you're going to change your rating, of course. All right, we're going to follow what you say, but I appreciate you giving us an update on what's going on.
At this point, it's fully valued, but it does show some promise.
Okay, all right. Now let's turn your attention. I want to ask you about what's going on in the tanker business. You say basically this business is lousy, right?
Yeah, I mean, we have too many ships being delivered over the demand that exists. We have contracting demand in the West, improving demand in Asia, particularly China, but that's not enough to hold things up. China's still not the largest consumer. So, you know, supply exceeds demand, and we have very weak rates. I mean, as we know right now, there are enough double-hull VLCCs, or very large crude carriers, sitting, showing available dates in the Arabian Gulf.
In other words, if you want a VLCC, anybody out there wants a VLCC, don't worry, call you. You'll arrange it. You probably get them a good deal.
No, you have to call a shipbroker for that.
Okay,
I used to be a shipbroker, but there are enough showing dates in the Arabian Gulf right now to meet what is expected to be demand out of the Arabian Gulf for September. Rates are very poor, probably going to stay fairly poor at least for the next few weeks, and it's going to be very rough on anybody exposed to spot crude tanker markets going forward. So Frontline is exposed. We do have a sell position there. They're at a historic high valuation. And TK has some exposure to smaller crude tankers as well as a weak product tanker market. But they're in better shape balance sheet-wise and are fully valued against next year, so I have a hold on them.
What about, let's say, like the LPs that are related to these tanker companies? Because, I mean, a lot of them spun off limited partnerships into separately traded entities. A lot of people buy them for the dividends that they offer. Are those dividends pretty covered, or is that going to be difficult this fall?
Without commenting on individual ones that I don't cover, for the most part, the MLPs have assets that are chartered to household names, and not for the most part, but in many cases, household names. I mean, names you would know, Exxon's and Petrobras and so on. That credit is good. They're going to get paid. So you have to look at the credit quality behind any MLP you may want to look at on the charter and on the client base.
Check out who the customers are before you make a decision as to whether that dividend's really covered.
I would say that many of them are in fairly good shape right now.
All right, let's talk about another company. This is Golar, and this is a specialty carrier, right? Because this is liquefied natural gas. I thought we were awash in natural gas, at least in the United States. Golar, I mean, what are they doing in business?
Well, the spot market for LNG ships is very weak, but that's not the only thing they do. They also do floating regasification of gas. So this is basically a floating factory, which does allow you to bring a ship into a region, set it up as a regasification facility, pipe it onshore, instead of building a plant in somebody's backyard, which nobody wants. There's plenty of gas. It's cheap. It's, obviously, it's abundant, and it's much cleaner. So it is a resource that is going to be used in the future. And these guys, Golar, are leaders in this technology.
Do you like the stock right now?
I like the stock. They just announced a restructuring, so the GLNG that we're seeing in this country is going to be a yield vehicle going forward, and they will have 5 projects fully online in the midpoint of next year. And so you'll see a dividend showing up there next year and growing.
Any idea what kind of yield we're going to be looking at?
Since I haven't published...
They don't know yet, okay, all right.
And they haven't said, I'm going to refrain from saying that, but they have indicated how much free cash flow they're going to have. It's significant. We do have a buy rating on the stock at this point in time, and well-structured as well. The liquefaction of gas is growing dramatically globally. There are a lot of projects, and the fleet overall is not growing as fast. Over time, just the fundamental base of the business to transport it is getting stronger, unlike other segments in shipping. So I think it's a very attractive place to do your homework.
All right, I'll give you about 15 seconds.
Yeah.
Unfortunately, container vessels, Seaspan, right? What's going on in the container business?
Seaspan keeps hitting their numbers on the bottom line, and they're paying their dividend of 10 cents at this point in time, which is down from approximately 47 cents per quarter. I do expect that over time they're going to keep hitting their bottom line. The industry's going to get healthier, and that dividend's coming up, but more like next year to look at that.
Okay.
But it is a buy-rated stock and has upside from here.
All right. Well, we'll have you back a lot sooner than next year.
Thanks.
Appreciate you coming in. Urs Dura, expert in the world of shipping for Lazard, a capital market.